Yes, I want to thank everyone for coming to this webinar from Trend Following Mentor called How Successful Traders Use Indicators to Place Stops. I want to first say one thing, that even doing this, there is no holy grail with any of the ideas that we're doing, and this is based for education. And also, I have an upcoming book coming out. Actually, it's called The Bible of Trend Following. I invite you to pick it up, as well as we have some home study courses. Let's jump on Metastock. Let me just move this down a little bit. I don't know if you guys see it. Basically, the way we work is indicators or systems aren't really what makes you successful. What's going to make you successful is your trading psychology. What does that really mean? That you find a methodology that you believe in and that you can follow. Because no matter what system or what methodology you're going to use, you're always going to have trades that don't work, which means losing trades. And then also you will go through long periods and you don't make money. And the thing is, many people are deceived with these high win ratios, and it's just a bunch of nonsense. I mean, I've been doing this for 18 years, and I'm sharing with you what really works in the real world. And really what you need to focus on isn't just the methodology. You need to focus on yourself, how you think. I'll give you an example. I'm traveling and I'm meeting all kinds of clients, and we had a discussion. And I presented a scenario where you have 3 different investors that over 5 years, each of them still generated a 10% return. And they did it differently. One guy, he basically swung for the fences. He might have hit 40%. He might have been down 10%. Might have been up 5%. And then he had 2 years that lost money. But he still had a 10% rate of return. Well, a lot of volatility. Then you had another trader who was pretty consistent. Maybe he did 15%. He did 5%, 6%, lost 5%, and then did another 8% or 10%. And he had a 10% return. Then you can even make another type of investor that had bigger swings. The bottom line is each of these investors, they think differently even though they have the same rate of return. And this is what it means. It has to fit your personality, because let's say the investor who swung for the fences and had the big drawdown at the end, he might quit and try to go look for something else. This is not what successful trading really is. What successful trading really is realizing or coming to terms with what is your compounded annual rate of return on average over long periods of time. Because the fact is, we have to know where we are in order to know where we're going. And we have a goal. I'll share another story, and then we'll get into these indicators. I spoke to a doctor who was 50. He did not want to keep on practicing medicine, had a nice nest egg, and he thought he could stop actually performing surgeries and start trading, make his life a little bit easier. And he thought, I asked him a question. I said, do you believe that your X amount of money, or let's say actually it was $500,000, do you have any idea what it could be worth in 30 years? I just thought, the guy, he's 50. The average lifespan of a male is close to 80 years old in the U.S. So I figured he had 30 years of compounding. And he had no idea. He thought at best $1 million. Well, I told him, if you can hit a 12% return on average, you can have $6 million. And he was in shock. So again, I want to instill in any of you that are listening to this, the ones that are listening live and the ones that are going to listen to it after, is think in terms of what your compounded annual rate of return is. It doesn't have to be just trading or trend following. Again, I'd stay away from selling options. I've heard that from many students. I'm going to promise you it's a disaster. You get 1% a month until you lose all your money. This is what's happened. I mean, you can do real estate, but the thing is you need to do something. And also what I do is I put it in terms of my children. That my one daughter is 20, my son is 19, that they have 60 years of compounding money. It becomes an astronomical amount of money if they can compound it. And this is what I instill in my children. So that is our goal. And then we get down to how to do it, which is the point of this webinar. And the idea is to keep you in the game. Because if you blow up, or if you lose too much money, because there is going to be a drawdown out there that will stop people from trading. Because drawdowns are not just financially hurtful, they're emotionally hurtful. So the point of this webinar is to discuss how successful traders use indicators to place stops. Why? So they can stay in the marathon of trading. Or, in my case, and hopefully many others, trend following. Because I really believe there's no other strategy except trend following. Because the fact is like this. In order to make money, just common sense, the markets have to move. They can have to do, basically, there's only three options. The markets can go up, they can go down, or they can go sideways. The only way anyone's going to make money is if the markets go up or they go down. And the idea is what you need to be flexible if you want to be a trader is that you have no opinion on the market. There was a saying that I read. Actually, I read Stock Market Wizards. I flipped through it, and it was a great, great piece about a gentleman who had, believe it or not, I don't have the book in front of me here, he was almost doing 100% per year with stocks from 1990 to 1999 until actually he was getting divorced and then decided he didn't want to trade anymore and returned his investors' money. But he said, you have to be a jellyfish. What does that mean? You just float where the market's going. What does that mean for us? Our opinions don't mean anything. I mean, they really don't. If the market wants to go up, you want to find the strongest stocks, if that's what you're trading, or if you're doing currencies, the strongest currencies or commodities. If you can put on a low-risk bet. Low-risk bet is where you're risking no more, in my opinion, and again, it has to match your personality, not mine, no more than 1% of your account size. What does that mean? You have a $50,000 account. That means you're taking a $500 risk to see if the trade works. And we're going to talk about that. The other thing, too, like on MetaStock, what I do, very simply, is I have an exploration. Where am I? Moving on over. And I rank the markets. I know what I want to look at. I buy the strongest, I sell the weakest. Like I can look at this quick report if it saves it. And I know that the weakest stocks are some of these, and I look to go short these. And I know the strongest ones are these. And I'm looking for a low-risk bet, which I said. Again, it doesn't mean the trade's going to work. It just means that I'm willing to risk 1% of my account. And I say everything is how you think. What I say all the time, and a lot of people don't seem to get this, I say, how much will this trade cost me to see if it'll even work? I'm going into the assumption it doesn't have to work. Think about that. And I'm even saying it work or not work. It isn't it's a good trade or a bad trade. The trades either work or they don't work. This is the most important aspect next to developing a methodology is having the proper mindset. This proper mindset means after you have 3, 4 trades in a row, that you take that next trade. You don't say, well, I'm not sure to take it. You have to be committed. You have to take every single trade because you know what? You miss one trade, that's your year. That's your year. It can happen. Every trade is statistically independent from the last trade. Very simple. So getting on to our point about these, let's say, how we call them, these indicators to place stops. The fact is like this. I use 2 stops. Some people use no stops. The reality is when you trade, you need to have a stop. There's people that talk about mental stops. Well, many times these mental stops, people freeze like a deer with the lights in his eyes and just freeze. And it's even professional money managers. There was a money manager at a brokerage in which I was a client that I heard the story that he had a large account. It was back in 2008. He froze. He went short in 2008 and the market spiked up brutally against him. And he wiped out, if I'm not mistaken, it was several $1 million of his account because he just froze. So the key I suggest is not mental stops, real stops. Going back a little bit more on the methodology, very clear. My methodology is an enhancement based on Richard Donchian and I had a mentor, that started in 1979. Richard Donchian started after losing all of his money in the Great Depression, and he thought you buy the X period day high or the 20-day high and sell the 10-day low. That's it. And many people confuse robust ideas to complicated ideas, and thinking the more complicated they are, the more apt they are to work. Well, it's not the reality. The reality is that you have robust ideas, but with a lot of money management tools to protect you and risk management tools to protect you, which I teach. The issue is, if Richard Donchian can do this for 50 years with all kinds of markets, why would anyone ever believe that trend following is dead or the markets have changed? Over a 50-year period, I'm sure that Richard Donchian saw all types of market conditions. And then even if I want to fast forward from 1979 till today, I have a colleague who's been trading, trend following, very simple, very basic. He wasn't just satisfied being a jellyfish in the stock market with his buy and hold and going through these ugly drawdowns. He saw what happened in 1973 and 74, where the Nifty 50, I think they were called, fell, I think it was something like 80, 90%, even though the whole market didn't fall that much. But he thought there had to be a better way. And he studied, he read, and you go back in the late 1970s, we didn't have the internet. We didn't have all these abilities to test ideas or even have the computer ideas. He did all this by hand. And he adapted the concepts of Richard Donchian, breakout strategies, very simple, very vanilla. And he started with a $200,000 account. He was a dentist, which is a lot of money back then, and compounded it, where today it's about 18 million. But I want to say something. It was not easy. He didn't have the magic formula. He didn't have the magic indicator. He had tons of losses. He had tons of times, or long periods of times, he did not make money. But what he does have was the discipline to follow his plan because he believed in it. He had the patience to let the plan work, and the focus to understanding that this methodology of trend following is a lifetime strategy. So he compounded his money, going through all the hardships, going through all the drawdowns, not having the most spectacular system, if that such exists, because it doesn't exist, but he followed it. And he was confident in the face of adversity. In the face of total uncertainty, he was certain that over time he'll stumble into some interesting trades. Not that he knew the future. And to today, this is what he's doing. So he took this $200,000 to about $18 million. Okay, that's my personal story. There's a piece that is on the blog. It's an article from Marhedge about a guy that invested in 1988 who ran it up in 2003. He invested with a CTA called Hawksbill. And the fact is that money turned from 1988, $300,000 to 2003 to $19 million. He pulled out $1 million and had $18 million trading account in 2003. If you want to, and I don't know because this article was dated in 2004, and again, I will gladly email you. You can email me at andrew@trendfollowingmentor.com. I'll email the article, or it's on the blog at trendfollowingmentor.com. And if you can imagine his level of compounding, let's say there's 18 million for 10 years, a fair assumption is it's probably going to be in the low 20, low $30 million range, mid $20 million range. This is what we're talking about. What is the idea to place stops? Staying in the game. Placing stops is not going to negate losses. You will have losses. You will have numerous trades, but you have to develop a methodology that fits your personality that you can follow. You have two choices, and it's exactly like I just gave the example. I gave you the example of the dentist who did his own trading. I gave you another example of a gentleman who allocated to actually Tom Shanks, who was he was one of the original Turtles. And for those of you that don't know what the Turtles are, they were a series of students of Richard Dennis and William Eckhart, they made a bet that if they can teach traders how to trade, and they put them in a classroom for a whole whopping 2 weeks, or let's say 10 days, taught them to trade. Very simple. They gave them the Dominion breakout approach. But the fact is, they didn't give them, they didn't spend all the time on the actual formula. What they spent the time on is learning how to have a winning trading mentality or a winning psychology, how not to have fear, how to follow a plan, how not to have greed, how to have patience when a trade works. These are the keys. Let me just give you an example about patience. To stay in this trade means having patience. I've had students that have exited trades that are working, and they exit for one reason. He says, well, I got bored, and it's really dumb. And I didn't say dumb in those words. I'm just like, I asked him, I said, what's your motivation? Why are you trading? And he says he likes the excitement. And I said, well, then go to Las Vegas. You don't need to trade because you will lose all your money. It doesn't make any sense. You need to trade for one reason and one reason only. That's to compound money over long periods of time. So just using this simple example, to be patient. Doesn't mean to be greedy and add more position on. You put your position on because there's people that will also leverage up. If you want to, that's your choice. But I've seen more people blow up because of leveraging up and taking more risk than they should take. Going to our point, you have two choices. You can do this on your own. Learn how to trend follow. You need to be patient. It will take you time. It's not, again, using the doctor example, what I said to him is I said, your analogy that you think you can buy a course and learn to trade successfully is pretty far-fetched. And I'll tell you why. It's like me buying a course on how to be a heart surgeon and thinking I'm going to be able to operate. I don't think you'd want to be my patient. So what I told the doctor, I said, really what you need to do is, what is your goal? The goal is to compound money. Do you really have the time to trade? Do you think you have the experience? So I suggested, I said, you know what? Go. And there's very, very few people that really get what, let's say successful trading is over time. And I said, look at this website. There's like 600 some odd commodity trading advisors in there. I said, personally, I like trading commodity trading advisors. I am one myself. But the fact is, you look at every single market. You can make money in corn. You can make money in gold. You can make money in the stock market. You can make the money in whatever. It's all the things of our human existence. But out of these large base of commodity trading advisors, because there's a lot of wannabes, I'd say about 90% of them I wouldn't even think about putting my money with. First thing you have to do is make sure that they at least have a 10-year record, that they've been doing this for at least 10 years. And then really what you need to do is focus on the risk. And then the next thing is you buy their drawdown. No matter what manager, no matter what trading system, no matter what of anything, there will always be losses and there will always be drawdowns. So giving that background, you have two choices. Basing on your goal to compound money. One is you do it on your own and have patience because you will make mistakes. And if you need my help, I can help you gladly. I've been helped. It's my way of giving back. That's one. The second thing is you can allocate to managers that really understand what it's all about. That is the general goal. Let's talk about these stops and really what they are. Again, they don't have to be so complicated, which people make them. And they use all these, I've seen guys make up all engineers. There's engineers, there's all kinds of programmers. They make all these sophisticated things. You know what? I'll just run it through to you like this. It's like a conveyor belt of ideas. First thing I do, here you go. I want to see what's strong, what's weak, like I showed you. Simple. The strongest and the weakest. And then I want to figure out what I can do, how I can get in there. If in a bull market in stocks, I want to be long. If I'm in a bear market, I'd rather be short. So I want to know where I'm at. Always figuring out where I'm at in order to know where I'm going. And even that isn't 100% because anything can happen again. And there's several simple indicators, which I teach, that will keep you on the right side of the market. There's no listening to Bloomberg or CNBC or Kramer. I watched him last night. I was like half asleep. I couldn't even believe People calling him and asking him, what do you think of this? What do you think of that? I'm sorry. Maybe he's good, but he's not God. Nobody knows the future. Not me, not you. But all we can do is try to take low-risk bets and let the probabilities unfold. So you need to know where you are in the market. Are you in a favorable market environment, or are you not in a favorable market environment? If you're in a favorable stock market environment, you want to buy the strongest stocks on a pullback or on a breakout that you're not risking too much. This is what I teach. I teach a breakout policy or a breakout methodology and a trend retracement policy where you have pullbacks. Either of these things will keep you in the trade, will get you started in the trade. Those are entries. Entries mean nothing. Exits mean nothing. Managing the risk and keeping losses means everything. There's only 4 possibilities, or let's even say maybe 5. You can have a big loss. You can have a small loss. But the thing is, in order to avoid the big loss, you put in a stop immediately in the market, which, let's just jump to the case. Let's say I have a breakout, and I know that Apple was one of the strongest back in December. It was one of the strongest. I would look, depending on my breakout methodology, and you get to pick the numbers because there's no magic number. You can do the 20-day high to the 10-day low. You get to pick it. Or maybe it's the 25-day high to the 15-day low. Guess what? There is no magic number. And in many cases, it probably doesn't even matter. But you figure out your hard stop first. This is rule 1 if you want to survive. So you avoid the big losses. And even this is not guaranteed. Because again, all we're dealing with is uncertainty. Because let me tell you what can happen. You can have a gap. You can have a limit move in anything, regardless of your stop. But the idea is, first of all, know what you want to buy. And look and say, well, how much risk do I have to put on? And then check that risk with the hard stop, which I just expressed. Well, let's say it was here, and I had an actual trade. Then the next major idea is, okay, so we have now 2 options. Big losses, which we're trying to prevent them. The other reality is I'm going to have a lot of trades with small losses, but that's okay. If I'm risking less than 1%, in most cases, let's say my own trading, I am losing when the trades don't work. Less than that, 0.5%, 0.75%, 1/8%. Big deal. Big deal. I know I'm going to have them, so it doesn't faze me. Then the next possibility is you're going to have small losses. Those are fine. I mean, you don't have to hang on. People blow up because they hang on and they take big losses. Things can fall very quickly, very rapidly, like the example Netflix or Chipolita. These things can fall out of bed very strongly, and you can get hurt very quickly. So that's why you have to have these hard stops and take the losses when they come, which many traders don't. They believe it'll come back. They believe it'll come back, like WorldCom, like Enron, until there is no coming back, until they're gone. And they've hurt their account financially and emotionally damaged themselves as well. So going on, you take your small little profits. They're okay. If you don't take the small profit, they can turn into a loss or a big loss. So you have to mind your trade. Take your small profit. But then you know what? Sometimes, rare times, you're going to stumble onto some of these big profits. Let's say here, with Apple went from, let's say, approximately 400 to about here. Oops. To about almost 600. A 50% move. You were patient. You were disciplined. Actually, you know what? You would have gotten taken out here. And if it was still one of the strongest, you would have jumped back in with a very low-risk trade. That's still a nice profit right here. This is what it's all about. Having a trading plan that fits your personality. That's issue 1. The next issue is believing in it and trusting it. And then the other really thing that most people do not even put 1 ounce of effort on is how to develop this trading psychology, this winning attitude. The winning attitude comes from following your plan, keeping your losses small so you avoid these detrimentally frustrating big drawdowns. The idea is believing that anything can happen, that anything will happen. It also means having the passion to trade, not for the sake of gambling and you're bored or you want entertainment. You want to make a financial difference in your life. And you want to compound money, because when you combine a robust methodology with risk management and money management, the winning, or let's say the appropriate trading psychology plus time, that means long periods of time. This is not a get rich quick, and you're going to have to work, and you are going to have lots of small losses, and the key is to keep them small. You will compound money over long periods of time. Compounding money over long periods of time creates extreme wealth. And you have two ways to do it. You can do it on your own, or you can allocate. And to allocate the whole process in its own. And it's not easy also, because how do you feel when this manager that you thought was next to God, which there aren't any, or a guru, because there are not any of those either, has his drawdown. And there will always be drawdowns. There's no way to prevent it. And I'll tell you this, some of the best managers, including Warren Buffett, who over the last 10 years had 50% drawdowns, he did something like 13-something%. And that was from, if I'm not mistaken, back in the 80s. It's part of I made up a PowerPoint presentation. I'm speaking at a conference in Chicago, and I really highlighted what are the realities. The reality is it's not easy. The reality is there's no free lunch and that you have to work. And even when you invest with a money manager, let's say what I said with these commodity trading advisors that are few and far above, whatever, that if you have 600 of them, maybe you have 30 that might get it, that have been around for more than 10 years, that even the best of the best, they're not immune to having drawdowns. They will have them. And you know what? The drawdowns are ugly. And the durations of the drawdowns are ugly. But you know what? The fact is, on average, it's not representative of all CTAs. It's a small handful of guys that have been around for decades, a small number of them, that they'll still have 20, 30% drawdowns, maybe even greater, because your worst drawdown is always ahead of you. And then at best, if you average in everything over all these long periods of time, they're a little bit more plus or minus of 15%. And some people get discouraged and said, oh, that's it? But I said, you know what? If you look at what 15% is over 20 years on $100,000 or $200,000, it's a mind-boggling amount of money. But you will go through pain. You will go through hard times. There's no way to avoid it. You'll do it with your own trading, or you'll even do it when you allocate. These are the realities of trend following. And really what my goal is that there's no surprises for you when you either, two choices, when you trade on your own and do this, or if you even attempt to allocate to a manager. It's not easy. But the goal is, if you can stay in the marathon, you can create extreme wealth. It is possible. I've written in my blog about, actually it was in today's post, about Kovner. And you can look at the blog. Here, I can even show it to you. 1 second. Where am I? 1 second. Bear with me. Well, first of all, let me just say one more thing real quick, just as long as I have this open. You can pre-order my book, The Trend Following Bible, on Amazon. It's called The Bible of Trend Following. But what I want to show you also in today's blog, and I invite you to look at the blog, because every day I'm trying to write something that is very educational, that you'll learn something. I mean, I really want you to really get it and succeed. And Bruce Kovner, when he started with Commodity Corp. There are many of you that know Commodities Corp. because it was almost like the incubation of successful traders. And there was a guy named Michael Marcus right here. He learned under Ed Seykota, and he taught Bruce Kovner one thing, and it's written right here. Michael taught me, and it's not my words. This is in Market Wizards from Schwager's book, Market Wizards. Michael taught me one thing that's incredibly important. He taught me that you can make $1 million. Let me just move this. He showed me that if you apply yourself, great things can happen. This is the truth. This is the reality. He is a trend follower. He's managing billions of dollars, Bruce Kovner. I don't know how many billion, but I mean, it's way up there. The fact is, you can do this. And you can be, as I said, you can be the pilot of the plane, or you can be in first class going for a ride with the money manager. I mean, if you have the money, you can invest with Bruce Kovner. I think something tremendous amount of money in order to, to invest with him. I mean, millions on top of millions of dollars he takes is his minimum. But again, if I can do this and learn this, if others can actually do this, you can too. It's not easy. It's not the Holy Grail. There will be lots of losses. There will be lots or long periods of really not making money. But then there will be these other periods that you step back and you say, wow, can you believe this is happening? And you have the propensity or the possibility to compound money. Just to wrap it up, there are no magic indicators. There are no magic anything. You have to spread it out if you're allocating to outside managers. Spread it out if you're allocating if you're doing your own trading. That's part of one of the other issues I teach, is to make sure that you don't get too heavy into any sector. But I've given you two simple, basic indicators that are as vanilla as you can get, but as powerful as you can get on how to use simple indicators to place stops in order to be or give you the possibility of being a successful trader. I'm going to take if there's any questions, I'll take some quick questions. Otherwise, I need to wrap it up. I need to jump into a meeting. Any questions, just put your hands up. Anybody, any quick questions? 1 second, questions. Okay. Okay, everyone, I appreciate you coming to trendfollowingmentor.com. Just to add one more thing, what I did, I guess really my own personal, why I did it was to build credibility with you, my listeners, my potential students. Besides having the book, besides having the one-on-one mentoring, is I made up these powerful, I call them study guides. Because when we were in school, they had cliff notes. You read these things, instead of reading a whole 300-page book or 200-some-odd-page book, and you save time. So I made a couple of them. I'm going to be making more of them. I put them up here for $1, just so you can feel how I teach. And it's not really any kind of a risk. And if you feel comfortable, they have a home study course, or actually, you can email me, and we can arrange a time to speak. And if I can help you, I will sure try to help you. I've been helped, and it's my way of giving back. My trading does not take that much time. I do it in the morning. It's very, within an hour, I'm done. And then the rest of the day, I research ideas so I can build a better or enhance my, let's say, trading system to even become even better. I want a world-class trading system like an athlete always trains. I'm very into sports, and my passion is building automated, systematic trading systems based on very simple, robust ideas. But I have time, and I talk to a lot of people during the day, and I invite you, if you have any questions or thoughts or concerns, email me. I'll try to email you, or we can also chat on the phone. Thank you very much.